$300 billion. Gone. That's not a market correction. That's not a temporary dip. That's the complete destruction of value at one of the most recognizable brands in digital finance. And I'm going to tell you something that's going to sound insane. The executives who oversaw this collapse? Most of them walked away rich, richer than they started. While shareholders lost everything, PayPal's stock has fallen 85% over the past 5 years. February 2026, and the company that once seemed untouchable is now worth less than the acquisition they almost made in 2021. Think about that. They're worth less than the bad decision they didn't even complete. But here's what nobody's talking about. This wasn't just bad luck or market forces. This was a masterclass in how corporate incentives destroy shareholder value, how short-term thinking backed by activist investors can gut a market leader, and how government policy, specifically the Federal Reserve, set the trap that PayPal walked right into. Let me show you exactly how this happened, because the full story is so much worse than the stock chart suggests. Start here. PayPal pioneered digital payments. Before PayPal, buying something online meant writing a check, putting it in an envelope, and mailing it to a stranger you found on the internet. It sounds ridiculous now, but that was reality in the late 90s. PayPal solved that. They made digital transfers safe, fast, and accessible. For years, and I mean years, they were the only name that mattered, the only platform most people could even identify. That dominance gave them pricing power. It gave them network effects. It gave them what every business dreams of having: a moat that seemed permanent. Except moats aren't permanent. They're only as strong as the company's ability to defend them. And PayPal stopped defending theirs. Square launched in 2009, focused on small businesses and physical retail, took a chunk of merchant processing that PayPal assumed they'd own forever. Then, Stripe came in 2010, built for developers, seamless API integration, and suddenly every startup building an online business defaulted to Stripe instead of PayPal. But those were targetable competitors, specific niches. PayPal could have adjusted. They didn't. Then came Apple Pay in 2014. This is where it gets interesting, because Apple Pay didn't just compete with PayPal. It made PayPal feel obsolete. No separate app, no login, no typing in passwords on a tiny screen. You just hold your phone near the terminal and you're done. By 2026, 85% of US retailers accept Apple Pay. That's not market share, that's infrastructure. When a payment method becomes infrastructure, the old platforms become legacy systems that people use out of habit, not preference. And here's the thing about competing with Apple. They don't need to make money on payments. Payments are a feature that makes their hardware more valuable. PayPal? Payments are the entire business. They have to extract fees to survive. Apple can undercut them forever and not care. That's not a fair fight. That's structural disadvantage. But even with competition intensifying, PayPal had a lifeline, the relationship that built them in the first place. eBay. In 2001, 2/3 of PayPal's payment volume came from online auctions. eBay was so essential that eBay acquired PayPal for $1.5 billion. For 13 years, that relationship was the foundation of everything. PayPal processed eBay transactions. eBay sent millions of customers to PayPal. It was symbiotic. Then, 2015, PayPal gets spun off, becomes its own publicly traded company. Wall Street loved it at first. 2 companies, 2 growth stories, more value unlocked. But 3 years later, eBay makes an announcement that should have caused panic. They're phasing out PayPal entirely, switching to a company called Adyen, a Dutch payment processor that most Americans had never heard of. eBay sellers would now receive money directly to their bank accounts, processed through Adyen's infrastructure. Let me be clear what this meant. eBay wasn't just ending a partnership. They were publicly declaring that PayPal was no longer the best option, that a smaller European competitor could deliver better service at better rates. That's a reputational disaster. Your longest, most important partner, the company that made you relevant, fires you and tells the market why. So now you're losing the revenue stream that anchored your entire business model. And you're facing competition from Apple, Stripe, Square, and whoever else smells blood in the water. This is where most companies either double down on what they're good at or get acquired before things get worse. PayPal chose option 3, reckless expansion funded by cheap debt, because in 2020, the Federal Reserve had dropped interest rates to 0. COVID hits, the economy freezes, and the Fed responds by making money essentially free to borrow. This is the political piece nobody connects to PayPal's collapse, but it's foundational. When money is free, companies stop thinking about profitability. They think about growth, scale, market dominance at any cost. Because you can borrow infinite capital at 0% and roll it into the next quarter's expansion plan. And for PayPal, the pandemic looked like validation. E-commerce sales jumped 43%. Everyone stuck at home, buying everything online. Digital payments exploding across every category. PayPal's stock price went vertical. Investors thought they'd found the next Amazon, the company that would own the infrastructure layer of digital commerce. PayPal's leadership believed it too. They started talking about acquiring Pinterest, $45 billion, for a social media platform that had nothing to do with payments. The logic was something about integrating shopping and discovery, the kind of vague synergy talk that makes Wall Street analysts nod along until the deal actually closes and everyone realizes it made no sense. $45 billion. That would be more than PayPal's entire market cap today. They almost spent more than they're currently worth on a company that sells vision boards. They didn't do the deal, thankfully. But the fact that they seriously considered it tells you how detached leadership had become from reality. Because while they were fantasizing about empire building, they were making a much worse decision with the core business. Early 2021, CEO Dan Schulman makes a prediction in front of investors. PayPal will reach 750 million active accounts by the end of 2025. 750 million. Let that number sit for a second. At the time, they had 377 million accounts, so in 5 years, they'd nearly double their user base. Amazon had taken 25 years to reach 300 million active customers. PayPal was going to add 373 million in 5. The market loved it. Stock price climbed higher. Analysts upgraded their price targets. Everything looked perfect. But here's what Schulman actually did to hit that number. And this is where the incentive structure completely breaks down. PayPal started paying people to open accounts, $5 to $10, just for signing up and adding a payment method. No purchase required, no transaction necessary, just create an account and collect your cash. Now, if you're a rational human being, you immediately see the problem. You're incentivizing behavior that has nothing to do with long-term value. You're buying registrations, not customers. But here's why they did it anyway. Executive compensation at PayPal, like most tech companies, was tied to growth metrics. Active accounts, transaction volume, total payment volume. The more users you report, the bigger your bonus. So Dan Schulman had a personal financial incentive to hit 750 million accounts, regardless of whether those accounts were real, active, or remotely profitable. And for a while, it worked. The numbers went up, the stock went up, Schulman's compensation went up. Then reality hit. Millions of people signed up for the free money and never used the account again. They didn't make purchases, they didn't send payments, they didn't engage with the platform in any meaningful way. Worse, and this is almost funny if it wasn't so damaging, a huge percentage of those new accounts were bots. Fake accounts created by automated scripts farming the sign-up bonuses. PayPal was literally paying bots to inflate their user numbers. By 2022, they had to admit what everyone suspected. They deleted 4.5 million accounts. Just erase them. Acknowledge they weren't real. But here's the thing. If they caught 4.5 million fake accounts, how many didn't they catch? How many of those active accounts were people who signed up for $10 and haven't logged in since? The 750 million target? Completely impossible now. By 2022, they quietly lowered their growth projections. Stopped talking about the goal. Hoped investors would forget. They didn't forget. When 2025 ended and the final numbers came in, PayPal had 439 million active accounts. They missed their own prediction by 311 million accounts. That's not a rounding error. That's a completely fabricated growth story that fell apart under the lightest scrutiny. And the stock price reflected it. That 85% collapse? It started right here, when investors realized the growth narrative was fiction. But wait, it gets worse. Because even though PayPal didn't hit the account target, for a while they had a backup argument. Transactions per active account were rising. Existing users were transacting more frequently. Maybe you don't need 373 million new customers if the ones you have are spending more. That worked until 2025. Then transactions per active account started falling too. Now you have fewer users than you promised and each user is worth less than before. That's the death spiral for a payments company. Declining engagement per user combined with slowing user acquisition means your revenue growth rate collapses. And this is where the political angle comes back. Because while PayPal was collapsing internally, the regulatory environment was tightening. The Federal Reserve started raising interest rates aggressively in 2022. Suddenly, debt wasn't free anymore. All those expansion plans funded by cheap borrowing? Now they're expensive liabilities on the balance sheet. But it's not just interest rates. Regulators started asking uncomfortable questions about fintech companies. How much risk are they taking? Are they really banks in disguise? Should they face the same capital requirements as traditional financial institutions? The Consumer Financial Protection Bureau started investigating buy now, pay later services, a growing part of PayPal's business. Congress held hearings on data privacy in digital payments. The EU passed stricter rules on payment processing fees. None of this individually destroys PayPal, but combined with internal failures, it creates an environment where PayPal can't maneuver. They can't undercut competitors on price because regulators are watching. They can't acquire smaller competitors because antitrust scrutiny is intense. They can't expand into new markets because capital is expensive and investors want profitability, not growth. They're boxed in. Meanwhile, other parts of PayPal's business were growing. Braintree, their merchant services platform, added volume. Venmo, their peer-to-peer payment app, became the verb people used for splitting bills. But here's the brutal reality. Neither Braintree nor Venmo are as profitable as the core branded PayPal service. Venmo especially. It's popular, it's growing, and it barely makes money. The part of the business that's declining is the part that actually generated profit. Then came the leadership chaos. Dan Schulman, the CEO who made that $750 million prediction, who oversaw the fake account disaster, left PayPal in 2023. Walked away with a compensation package worth tens of millions. Didn't face any consequences for the value destruction. Recently became CEO of Verizon, by the way. His replacement, Alex Chris, got fired less than 2 years later. The board decided he wasn't fixing things fast enough. But honestly, what was he supposed to fix? The fake accounts were already deleted. The eBay revenue was already gone. The competition wasn't going away. The CFO situation was even messier. Blake Jorgensen left in 2023 after being on medical leave for 6 months. He'd only served as CFO for a few weeks after replacing the previous CFO. That's 3 CFOs in basically 18 months. Different strategies, different priorities, no institutional continuity. And here's the part that should terrify anyone still holding PayPal stock. In 2022, Elliott Management, one of the most aggressive activist investors on the planet, bought $2 billion of PayPal shares. They specialize in taking control of struggling companies, cutting costs, and forcing turnarounds. Elliott pushed for mass layoffs. They closed PayPal's San Francisco office, cut 7% of the workforce, demanded cost reductions across every department. Then 1 year later, Elliott sold their entire stake. Just gave up. Let me repeat that. An activist investor famous for hostile takeovers and ruthless operational changes took one look at PayPal's trajectory and decided it wasn't fixable. They lost money and walked away. That's not a vote of no confidence. That's a declaration that the patient is terminal. So what actually killed PayPal? The surface-level answer is easy. Competition intensified, Apple Pay took market share, the eBay relationship ended. The pandemic boost was temporary, but the real answer is about incentives and timing. PayPal's executives were incentivized to hit growth targets, not build sustainable value. So they bought fake users with shareholder money and reported growth that didn't exist. The Federal Reserve made capital free, which let PayPal and every other tech company operate without discipline. Growth at any cost made sense when borrowing was 0%. It stopped making sense the second rates went up, and PayPal mistook temporary pandemic conditions for a permanent shift in consumer behavior. They thought e-commerce growth would continue forever. It didn't. Here's the principle that matters. When a market leader tries to fight emerging competitors by acting like a desperate startup, spending recklessly on user acquisition, changing strategy every quarter, chasing growth metrics instead of profitability, they lose twice. They don't move fast enough to compete with actual startups, and they destroy the stability and trust that made them a leader. PayPal forgot that payments are about trust. Trust that your money arrives. Trust that your data is secure. Trust that the platform will exist in 5 years. You can't buy trust with $10 sign-up bonuses. And you definitely can't buy it with fake bot accounts. The scariest part? PayPal isn't done falling. the stock might be down 85%, but the underlying business problems haven't been solved. Transactions per user are declining, competition is intensifying, regulatory pressure is increasing. Meanwhile, there's a new threat nobody's talking about yet. Central bank digital currencies. The Federal Reserve is researching a digital dollar. China already launched their digital yuan. If governments start issuing their own digital currencies with zero transaction fees, what exactly is PayPal's value proposition? You're telling me I should pay PayPal fees to move money when the government will do it for free? That's the existential question PayPal can't answer. And it's coming faster than anyone realizes. $300 billion in value, destroyed by executives chasing bonuses instead of building. That's the lesson. Not competition, not technology, not market forces, incentives. Always look at the incentives.